A few months ago, Groupon did a 20-for-1 reverse stock split to revive its stock price. A reverse stock split is a signal of a company in distress. It's trying to keep the stock price high enough so it doesn't get delisted and it stays on investors' radars. And you can see in this article it says investors didn't take kindly to Groupon's plan. The stock price was $1.41 at one point. In the second quarter of this year, Groupon cut 2,800 jobs. Let's look at a company a little deeper to figure out if it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Groupon stock by analyzing their financial ratios and dissecting their financial statements, so we can determine if the stock is a buy or a sell. Groupon is an online marketplace connecting subscribers with local merchants by offering activities, travel, goods, and services in 15 countries. It started in 2008. Let's get started with the model. This is a small cap company, 600 million market cap. They're trading at $20.81 a share. And to get the shares outstanding, it's market cap divided by stock price gives you shares outstanding 29 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have positive free cash flow each year, but it's pretty small in 2019. The net income is a profit and loss for the company. It's revenue minus expenses, and they have negative net income in 2 of the 4 years. And their revenue seems to be declining each year. It goes from 3.1 billion to 2.2 billion. So their financials don't look so great. You can see in 2016 they had negative operating income, so they couldn't even operate their day-to-day business at a profit. They did turn that around and they squeaked out a small profit in 2017, 18, and 19. The reason they had negative net income was they were passing through lots of losses. The bigger ones are the gain on sale of security. So the company has investments in a couple of companies, Monster being one of them. So if the company they're investing in report negative net income, they also have to report that as a loss on their income statement. But they reverse that out on the statement of cash flows because it's a non-cash item. The reason it's a non-cash item is because they haven't sold the investment yet. If they did sell the investment, they might realize a loss, but it's more of an accounting thing. They also had $10 million of write-offs in 2019 and 2018. Although it is good to see they have positive free cash flow, if they keep writing down their asset base, it really weakens their balance sheet. Let's look at a capital structure. $215 million of debt, $394 million of equity. They pay 3.25% interest on their debt, and the cost of debt is 2.57%, which is the interest rate times 1 minus the effective tax rate. And they have 35% debt in their capital structure, which means they have 65% equity. Cost of equity is 19.45%. To calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And they have a beta of 2.23, so the stock moves more than 2 times the market. So it's a pretty volatile stock. And their WACC is 13.49%, which is a blend of the cost of debt and cost of equity. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4. That's $407 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $365 million. We divide that by 29 million shares. And we get a calculated stock price of $12.70. They're trading at $20.81, so they're trading at a 64% premium. It's a sell according to the model. Simply Wall Street values them at $25.74, so they're saying the stock is undervalued. They're in the other direction as me. Let's see where the stock has been trading the past 12 months. According to this chart, it looks like the stock was trading at $60, but it was actually trading at 1/20th of these prices. So it was trading around $3 at its peak. The company did a 1-for-20 reverse stock split in June 2020. So the stock was trading a little over $1 when they did the reverse stock split. It brought the price to a little over $20. The stock price did come up a little bit, but came back down, so it's pretty steady since the reverse stock split. If you invested $100 in Groupon in December 2015, you'd have $78 at the end of 2019. If you invested $100 in the NASDAQ Composite or NASDAQ 100, you'd have a lot more money. So obviously the stock price has been struggling the past few years. And this company does not pay a dividend because it doesn't have any money to give out to its shareholders. It needs to keep all the money in-house to grow the company. If you invested $10,000 when this company IPO'd in 2011, you'd have $400 today, a 96% loss. The company has three categories: local, goods, and travel. They're really trying to focus on growing the local category. If they focus on growing the local category, this will help small businesses and of course the large chains as well. The goods category is where Groupon sells goods directly to its customers, but they're going to exit the goods category this year. They also have a travel category where they offer hotels, airfare, and packages. Customers access the Groupon website through their phone or computer, and they buy vouchers that can be redeemed through third parties. My business uses Groupon, and I have to give half of my sales to Groupon. So if I sell a $100 voucher, I have to give them $50. The company's margins are significantly higher using the Groupon app than opposed to selling products. That's why they're exiting the goods category. Groupon decreased their marketing spend in 2019 by $56.4 million, or 14% when compared to 2018. They're launching a 2020 marketing strategy to really focus on the small businesses and the local businesses. The company uses SEO, search engine optimization, email notifications. They also have third-party affiliates to help promote their offerings. Let's look at some of the risks mentioned in the 10K. Acquiring and retaining customers is such an important part of Groupon's business. It seems like Groupon is struggling finding new customers as the internet evolves. Also, an extremely important part of Groupon's business model is finding high-quality merchants. Even if they had all the customers in the world to buy vouchers, they still need companies to offer those vouchers. The company is realigning its sales team to target merchants in core cities. There's no guarantee a merchant will stay with Groupon. They could terminate the relationship at any point. Also, another factor, especially during COVID, merchants can go bankrupt, which lessens the number of merchants that can be on the Groupon platform. Another risk when investing in Groupon is the highly competitive industry. It's a pretty low barrier to entry to do what Groupon does. There's also inventory management risk, because sometimes Groupon purchases inventory for sale to its customers, so if it purchases too much or too little inventory, it could be a problem. There could also be logistics issues with delivering the products. I think Groupon's brand name makes them the leader in this industry. But as the internet evolves, I could see Groupon's brand diminishing, unless of course Groupon stays ahead of the curve. Let's look at their financial ratios. The average PE ratio is 17.1, the median is 15.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE, so we can't look at this ratio. The average price of sales is 4.6, the median is 2.0. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 0.3, so investors are paying 30 cents for $1 of revenue. The average price to book is 4.7, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.5, so investors are paying $1.50 for $1 of book value. Equity is total assets minus total liabilities on the balance sheet. The average interest coverage ratio is 12.6, the median is 3.9. Interest coverage ratio is EBIT over interest expense. They're at 5.7, so they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. Average ROE is 13%, the median is 12%. ROE is net income over equity. They have negative net income, so they have negative ROE. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities, so they can cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on Spotify, Facebook, Google, Match, Trivago, Yelp, and Yandex, all in the same industry as Groupon. And if Groupon has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they are worse in PE because they're negative. They have the best price to sales ratio of all the companies. Price to book is a lot better than average. A worse than average current ratio, but they're above 1, so that's okay. Negative ROE, so they're worse than the average. Most companies in this industry don't use debt, so they're a lot higher than average in debt. They're a really small company compared to the average of $217 billion. And nobody in this industry pays a dividend. To summarize, I have them trading at a 64% premium. The ratios and financials don't look so good. So let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.